Part 4, Chapter 11, Intangible Assets, Natural Resources, and Group Depreciation. Now, intangible assets. Intangibles with estimated useful life, we amortize over the service life. Intangibles with an indefinite life, we do impairment tests annually or more if needed, but we don't amortize them. Now, intangible assets, the useful life is the legal, regulatory, or contractual provisions often limits the useful life of an intangible asset. Useful life might sometimes be less than the asset's legal or contractual life. Residual value is the expected residual value of an intangible asset, and it's usually zero. The residual value is not zero if at the end of the asset's useful life to the reporting entity, the asset will benefit another entity. Allocation method. The method of amortization should reflect the pattern of use of the asset in generating business. Now, difference between GAAP and IGAAP. We prohibit revaluation of any intangible asset. Under the international standard, it allows a company to value an intangible asset subsequent to the initial valuation at cost less accumulated amortization or fair value, if fair value can be determined by reference to an active market. Goodwill, however, cannot be revalued. So under GAAP, you can't write up an asset. That's our general rule right now. But under the international standard, you can. And it goes to other comprehensive income under the international standard. Now, let's take a look at an example. My company purchased a patent for $500,000 with a legal life of 12 years and a useful life of 10 years. We're going to use the useful life because legal life doesn't matter if we're not going to use it that long. On January 1st, they spent $40,000 successfully defending a patent and estimate now that the service life is 7 years. At the end of 2020, the patent had a fair value of $400,000. Now, first of all, what is the amortization? It's $50,000 a year. What is the journal entry for the legal fees? You would capitalize them to patent. It's any cost that you spend on it outside the company. That's usually the rule. Now, what's the annual amortization for 2020 after we successfully defended the patent? We would say cost less prior amortization plus legal fees. We would divide by the remaining years, which is 5, and we get our new amortization rate. What adjustments should be made based on fair value under GAAP? None, because we don't write up intangible assets under GAAP. Now, what about under the international standard? Under the international standard, what we would do is take the book value at 120, amortize expense for 2020 is the $88,000. So now we have a book value for the patent of $352. We would subtract the fair value, which means we can write it up by $48,000. And so this would be our journal entry. Patent would go up by $48,000 and revaluation surplus would go to other comprehensive income. Now, what about depletion? Now, we usually don't spend much time on this in accounting because very few people ever do it because it's such a unique requirement, but we're going to go over it anyways. So, allocation of costs of natural resources. Now remember, what you have here is you spend money on something assuming you're going to be able to extract so much, and then you're going to allocate the cost while you're extracting it. Because the usefulness of natural resources is directly related to the amount of resources extracted. Service life is the estimated amount of natural resources to be extracted. Fixtures or equipment associated with the natural resource that cannot be moved or allocated based on service life or asset or service life of natural resource. Okay, so what they're saying is if you buy a piece of equipment and its useful life goes beyond the life of the expected life of extraction, you have to use the extraction life. That's really what that's saying. Depletion of natural resources and depreciation of assets used in extraction of natural resources are part of product cost. So these are going to go to inventory until sold, then they're part of cost of goods sold. So, May 4th, company purchased the rights to a coal mine. The purchase price is $6.3 million. In addition, they purchased equipment for $180 that cannot be moved with a service life of 6 years and no residual value. The company expects to extract 900,000 tons over 4 years. During 2020, 240,000 were extracted. So, depletion for the year. It's going to be $7 times 240 tons that were extracted. I'm assuming that's tons. Yeah. Equals, they would deplete 1.6,800,000. Depreciation for the year, we're going to use the 4 years because it can't be moved or used for anything else. So it's going to be 48,000. So that's how we would compute that. Now, the last thing we're going to cover is group depreciation. Group and composite depreciation methods, this is when you just want to throw it all in one place and use one rate, which is a heck of a lot easier. So, group depreciation is if they share similar service lives and other attributes. Like all the computers, you could throw into one and say they average 5 years, and that would be fine. Even though some may cost 2, some may cost 20, you just put them all together. Or you can use composite depreciation, a collection of depreciable assets that are physically dissimilar but are aggregate anyway to gain the convenience of a collective depreciation calculation. So those are 2 possible easy ways instead of having to worry about each one. Now, possibility of changes in constitution of the asset group as new assets are added and others are retired. Additions are recorded by increasing group asset account for the cost of the addition. Depreciation is determined by multiplying the group rate times the total cost of the assets in the group for that period. And just so you know, the difference goes to accumulated depreciation. So let's take a look at an example. Now, before we do that, after the group or composite rate and the average service lives are determined, they normally are continued despite the addition and disposition of individual assets. No gain or loss is recorded when a group or composite asset is retired or sold. It's just an adjustment to accumulated depreciation. Any actual gain or loss is included in the accumulated depreciation account. So now we can look at an example. Now, a company decides they want to do group depreciation. So we have a bunch of trucks. They're similar. They're all cars in one form or another, but different values. So what we do is we're going to calculate the annual depreciation on each, take the total cost minus the residual value, gives us our depreciable base. And what we're going to do is divide the annual depreciation by the total cost. That tells us we have a group depreciation rate of 16.9%. Now, if you notice, it's based on total cost, not depreciable base. Now, average life is going to be the depreciable base divided by the annual depreciation. So now let's look at an example of what could have happened. So in 2020, they decided to replace 2 trucks with 2 new trucks at $20,000 each, and they sold the 2 old trucks for $6,000 with an original cost of $15,000. So to record the new trucks, it would be trucks, cash. To record the sale of the old trucks, it would be the cash. We would take the old trucks off the book, and the plug goes to accumulated depreciation. Now, what is our December 2020 depreciation? It would be the total of our assets now, which is going to be $395, times our depreciation rate gives us $66,755, and that would be our journal entry. That concludes part 4.